Silver markets are going absolutely wild right now. In Shanghai, prices are hitting record highs, trading at a massive premium compared to the West. And, of course, the internet is buzzing about a free money trade. But is it for real? Today, we're going to cut right through all that noise and show you what's actually happening in the silver market. Let's dive in.
So, just take a look at this chart. The red line, that's the silver price in Shanghai. The blue line is the price out here in the West. You can see, for the longest time, they moved in lockstep. But look what's happened recently, a huge divergence. We are talking about a premium of over $15 an ounce. That is a historic gap, and it's what's getting everyone so excited.
And, this massive price difference has not gone unnoticed. Social media is just on fire with posts exactly like this one, calling it absolute insanity and a sure sign that the market's breaking. So, naturally, everyone's asking the same question. Is it really as simple as it looks on the surface? I mean, can you actually just buy silver in New York for around $108 and then immediately sell it in Shanghai for $124 and just pocket that $15 profit? It sounds a little too good to be true, doesn't it?
Well, the short answer is a hard no. That is not how the global silver market actually works, and frankly, anyone betting on that simple trade is fundamentally misunderstanding the whole system. So let's break down exactly why.
All right, so let's get into the weeds and break down exactly why this whole free money story you're seeing everywhere is just plain wrong. You see, the reality of the global silver market is way more complicated than a simple price chart.
It's not just one thing stopping this supposedly easy trade. It's actually a whole series of real-world hurdles, which I like to call the arbitrage killers, that make this profit disappear. Let's start with the biggest one right at the top. Okay, this is the crucial detail that almost everyone misses. The price you see quoted for silver in Shanghai already has China's value-added tax, or VAT, baked right into it. The moment you factor that tax out, a huge chunk of that $15 premium just vanishes. The real price difference is a lot smaller than it looks. The next big hurdle is just the fundamental difference between these two markets. See, in the West, on an exchange like COMEX, you're mostly trading paper contracts, essentially IOUs for silver. But in Shanghai, on the SGE, it's all about the physical metal. They want the actual silver bars, and you just can't swap a paper promise for a real bar that easily. So, to put it as plainly as possible, you cannot just buy a paper contract in New York and then turn around and expect to sell a physical bar in Shanghai. It doesn't work that way. And once you add in China's strict import rules, the real-world costs of shipping and insurance, and the risk of currency fluctuations, well, that free $15 profit is long gone.
Okay, so if it's not a free trade, what is this premium actually telling us? What's the real story behind all this price action? Well, it all comes down to the classic powerful forces of supply and demand. On the demand side, things are just surging. Silver is a critical industrial metal, right? It's absolutely essential for solar panels, for electric vehicles, for all kinds of advanced electronics. That demand is accelerating. But then you look at the supply side, and mining output has been pretty much flat for years, with very few major new projects coming online. And when consumption is outpacing production, prices have to go up. That's just economics. So what's the balanced, rational view here? Well, that Shanghai premium is a crystal clear signal of incredibly strong physical demand for silver, especially in Asia. But we also have to remember, these kinds of premiums can be really volatile, and they can disappear just as fast as they appeared. The best way to think about silver long-term is as industrial money. It's a crucial commodity that also has a role as a monetary asset. It's not a meme. So what's the main takeaway from all this? How should a smart, rational investor actually process this information without getting swept up in all the hype?
It really comes down to a simple two-step framework. First, you have to see the premium for what it is, a powerful signal about the underlying physical market. It's screaming that the demand for real physical metal is very strong. But second, and this is just as important, you must not mistake that signal for some kind of trading hack or a get-rich-quick scheme.
And this is where we need to step back and think about the real role of precious metals in a balanced portfolio. Yeah, they can be a great store of value, a hedge against uncertainty, but they are not typically a speculative, get-rich-quick investment. For most investors, stocks are still going to be the main engine for long-term growth. So to wrap this all up, the key message here is that the silver market isn't broken. It's not just moving because of some online hype. No, it's responding logically and rationally to some very powerful, very real-world fundamental pressures of supply and demand. And that really leaves us with this one final thought. The Shanghai premium is a fascinating, important indicator of what's happening in the global economy. Just don't confuse a powerful market signal with a free trade. As always, the best approach is to stay informed and stay rational. And finally, our standard disclaimer. Please remember this content is for educational purposes only. I am not a financial advisor, and this does not constitute financial advice. You should always do your own research before making any investment decisions.